Okay, Assalamu alaikum again. I took a short break. I hope you have also taken a break. Anyways, we'll continue with this topic, impairment. Impairment is a new topic for you girls. Basically, what does it mean? It means that maybe you have been using an asset uh, during the life of an asset, and when you showed the value of the asset on the balance sheet, right? Now when you compared between the saleable value of the asset, or maybe the fair value of the asset, or maybe whatever is the physical value of the asset that you see in the asset as you are using it, and the balance sheet value, you find that, let's say, the balance sheet value is higher, but the actual value when you look at it looks like lower. In that case, you find that you are overestimating the value of the asset in the balance sheet, and you need to make adjustment for that, right? So that's the idea. So let's talk about it in this slide. Recognizing impairment. Let's say a long-lived tangible asset is impaired when the company is not able to recover the asset's carrying amount either by using it or selling it. So there are two options here. By using it, also it's not finding that much use as much as the value it is showing in the balance sheet. Or if I'm trying to sell that asset, maybe a used asset, when I'm trying to sell, the money that I'm going to realize would not be as much as what I'm trying to show in the balance sheet. So this means the asset has been impaired. Now, should the company continuously monitor their fixed assets to see whether there is any impairment? Now, that's a big question in today's world. Especially big companies are concerned about the impairment of assets, and it is a big topic. So let's discuss that in detail. Right, so on an annual basis, companies review the asset for indicators of impairment. That is there a decline in the asset's cash generating ability by making by using it or by selling it, right? So how do we calculate the impairment? Now this is the can I call it a flow chart? Right, basically you have to calculate the carrying value of the asset, which is the value according to the balance sheet, and compare it with the recoverable amount. Now, what do you mean by recoverable amount? Recoverable amount, see, it could be like either you're using it or selling it, right? So, whichever is the higher of either the fair value less the cost to sell, that is the money that you're going to realize from the sale of the asset, or the value as you are using it, right? So in cases when both of them are given, let's say you know the fair value if you're going to sell it today, and you also know the value in use, then you have to take the one which is higher than the two to compare it with the carrying amount, right? So if the carrying amount is more than the recoverable amount, then there is impairment. If the carrying amount is less than the recoverable amount, then there is no impairment. So let's illustrate that here. So let's say Scruz SA performs an impairment test for its equipment. Let's say the carrying amount is 200,000 euros, and the fair value less cost is 180,000, and the value in use is 205,000. So these are the amounts in each of this blue column. Carrying amount 200,000, fair value minus the cost to sell is how much is that? Yeah, 180,000 and 205,000 for value in use, right? So how would you calculate? So first thing you need to do is take the higher of these two amounts and then use that higher amount to compare with the carrying amount, right? So we'll do that. So we'll put this amounts first. So can you see of these two, which is higher? Fair value or the value in use? Value in use, right? So we'll use the value in use to compare with the carrying amount. Now look at the carrying amount and look at the recoverable amount. Recoverable amount is 205 and the carrying amount is 200. So what do you think? Is there an impairment? Yes, you're right. There is no impairment because the recoverable amount is higher, right? So there is no impairment. Now let's continue this example. So let's say what if the value in use was 175, not 205, right? So in that case, again, let's look at the values. So here you put, now what you do first thing is compare between these two values. So 175 and 180. So sorry, 180 is the higher amount, so we'll use this in the comparison. And now what do you think? Carrying amount is 200,000 and the recoverable amount is 180,000. Is there an impairment? Yes, there is an impairment, and the impairment amount is 20,000, which is considered to be a loss in maybe impairment, which has to be adjusted by passing a journal entry, right? So in this case, the impairment loss is 20,000, and the entry that you will pass will be impairment loss debited 20,000 and accumulated depreciation credited. Now, what it means is that in order to adjust the value of your asset, you have to add, or you have to, we can say, increase the amount in the accumulated depreciation account. That's why you're going to credit it. Fine. Come, let's look at this another illustration. Now let's look at this case and try to understand it. At December 31, 2020, Hanoi Limited has equipment with a cost of 26 million VND, some sub-currency, and accumulated depreciation of 12 million VND. The equipment has a total useful life of 4 years with a residual value of 2 million VND, and some more information related to the equipment. So what are those information? First thing, the equipment's carrying amount is 14 million VND, which was calculated as 26,000 VND minus 12,000 VND. If you will notice, that is cost minus the accumulated depreciation, which means it is the depreciable cost. In other words, here we call it as the carrying amount, right? Fine. So it uses straight line method of depreciation. Hanoi's depreciation was 6 million VND for 2020, and this is how it was calculated. It said cost minus residual value divided by the useful life. So in 2020, this was already recorded. Hanoi has determined that the recoverable amount, so now we come to the second part, recoverable amount is $11,000. So the remaining useful life is 2 years. So our question, oh, is there an impairment test for the impairment and uh, maybe the journal entry and so on. Okay, so let's start with the test. I put this slide here again so that we can refer to it if you have any confusion. Fine. So okay, so here we say Hanoi records the impairment, yes or no. So first of all, let's compare the carrying amount 14 million as we saw before. Recoverable amount is given 11 million. So you see recoverable amount is less than the carrying amount. So yes, there is an impairment loss of 3 million. So they have to pass an entry, loss on impairment and accumulated depreciation 3 million VND. Correct? So what next? We also need to see now uh, in on 31st of December 2020 what was the carrying value and if there was an any adjustment required in impairment. Okay, so Hanoi determines that the equipment's total useful life has not changed. That means it still has 2 years if you're taking 2020 into consideration. However, the residual value of the equipment is now 0. What does that mean? Because here it has reached the end of the useful life and there is no residual value, right? So Hanai continues to use the straight line methods of depreciation. So only thing they have to do now is to pass the journal entry for depreciation. And what is the amount of depreciation? So you could see here now the carrying value on 31st December 2020 is 11 million. So 11 million and 2 years of useful life. So divided by 2 should give you the amount of depreciation each year, and that's the entry you will pass. Depreciation expenses debited and accumulated depreciation credited for 5,500,000. I hope I explained that. We'll take another case here. In this case, let's say at the end of 2090, Verma company tests a machine for impairment. The machine has a carrying cost of 200,000. It has an estimated useful life of 5 years. Because there is very less market related information on which to base a recoverable amount based on the fair value. So they determine the machine's recoverable amount should be based on the value in use. Okay, now this illustration actually shows us how the value in use was calculated. So let's use the information. Verma uses a discount rate of 8%, and Verma's analysis indicates that they will have a future cash flow of $40,000 each year for the next 5 years. Now I want you to understand this idea. 40,000 each year for the next 5 years is actually this fixed amount of money for the next 5 years. We call this as a annuity. So we have to use the annuity table to find the present value. Okay, it will receive a residual value of 10,000 at the end of 5 years. So also there is a 10,000 worth of residual value. Maybe we can also check this out. We can find the present value of this 10,000 today in order to know what is the value in use related to the machine. Okay, so basically what I want you to understand is that here we do not know what is the fair value of the asset. So the company says, okay, fine, for the next 5 years we are estimating that this machine is going to generate 40,000 dollars of cash flow, and at the end of its life we are also going to get a 10,000 by selling the old asset. So now we want to find out what is the value today if I'm using a present value technique. So this is exactly what we do. So first thing is do the present value of all these cash flows, 40,000 for 5 years. So we use the annuity table and navigate it to 8% for 5 years. Here we got the table value 3.99271. So 40,000 into 3.99271 is 159,780.4. Sorry, 708.4. And then you have 10,000, which is the residual value at the end of 5 years. So do the PV for a single cash flow for 5 years from the table, and you got 0.6858. So this will be the two present values, add them up, and this will give you the value in use related to machine. So 166 154.2, right? Compare this with the carrying cost and decide for yourself if there is impairment or no impairment. What do you think? Yes, what do you think? Yes, there is an impairment loss, and it is 33,486. So that's what they have passed an entry for: impairment loss debited and accumulated depreciation on machinery credited. Fine. So next we talk about impairment, but we will say, what if, let's say you have already passed that entry for loss on impairment, but later on you realize that there was actually not a loss, you actually have a gain. What if you have found out later that the loss that you have already deducted was not actually the case? In that case, is it possible to reverse the impairment loss? Okay, now IFRS says yes, you can reverse the impairment losses in almost all the cases. Okay, so let's have a look at this example. Let's say TAN Group, it purchased equipment on January 1 for 300,000, I think, Hong Kong dollars or something like that, and its useful life is 3 years, and there is no residual value. So in that case, here they have calculated depreciation and the carrying amount for each one of the year. At the end of 2019, the carrying amount would have been 200,000. At the end of 20, it would have been 100,000. At the end of 21, it would be 0. So on December 31, 2019, is there an impairment loss? So what we need to do is look at this 200,000, right? This 200,000, and then, okay, they have just given you the amount of impairment loss. They said that on December 1, there is an impairment loss of $20,000. So can you record that? Fine. So you pass an entry: loss on impairment 20,000 and accumulated depreciation 20,000. Fine. So now that you have a loss on impairment of 20,000, what? Let's look at the question further. So imagine the depreciation expenses and the related carrying cost has already been done. So let's say in 2020, this was the depreciation expense. Now, where did you get this 180 from? From the previous question. Okay, so here, could you see 200,000 was the carrying cost, and then there is a loss on impairment 20,000. When I minus that, I mean, it was added to the cumulative depreciation. So when I take that in 2020, the value of the asset would have been 180,000, right? So 180,000 and 2 years remaining, so divided by 2. So 90,000 was the depreciation expense, and the carrying amount is 90,000. You got this by taking 180,000 minus 90,000. Fine. So at the end of 1990, they found that the recoverable value is 96,000. So see, carrying cost is 90,000, recoverable value is 96,000. So basically, there is no impairment loss. But remember, you have already passed an entry for impairment loss. So now you can reverse that entry. Reversing of the entry is just passing an opposite transaction or opposite journal entry to what you have already done, but instead of saying loss, you use the word recovery of impairment loss. So why is it 6,000? Could you see the recoverable value is 96,000, but the carrying cost is only 90,000. So you're trying to increase the carrying cost by 6,000. Fine. So next we talk about cash generating units as a part of the impairment discussion. When it is not possible to assess a single asset for impairment because maybe single asset generates cash flow only in the combination of other assets, maybe like the example I gave you for components in the depreciation, then companies have to usually what they do is they identify a small group of assets. They say that together they are going to generate so and so cash flow, and so you don't calculate them independently, rather you take it as a group. Okay, the next top point we'll discuss here is what if you have an asset but you're not using it, you're just keeping it maybe till you can sell it off or till you can dispose it off. So here we say impairment of those assets that are to be disposed. Okay, so in that case you may report the impaired asset at the cost of low or net realizable value, that is fair value minus the cost for selling, and you do not charge any more depreciation on that asset because you're not using it, or amortization for that matter. So you will not charge any depreciation or amortization on those assets which is not in use, but it is just been kept aside for maybe for disposal. Right, you can write up or down the value of the asset, doesn't matter. You can say that okay, the value has increased or decreased, doesn't matter, but as long as the carrying amount after the write up can never be more than the value of the asset before the impairment. Okay, so how does that work? Let us have a look at that. So your impairment test works like this. This can be a discussion question. What is the procedure of impairment? So what you do is the impairment test says that just look at the recoverable amount. Remember, what is recoverable amount? Recoverable amount is the value of the value in use or the fair value for the sales minus the cost of sales, right? Whichever is higher, and compare it with the carrying cost. So is the recoverable amount less than the carrying cost? If it is not, then there is no need of impairment because the carrying cost is less than the recoverable amount, right? However, if the recoverable amount is less than the carrying cost, yes, then you need to do the impairment. So impairment, the way in which you handle impairment differs between the assets that is being used and the asset that is not in use but you're just keeping it aside for disposal. So if you are going to apply the impairment on asset in use, so what you do is first calculate the impairment loss, that is what is the difference between the carrying amount and the recoverable amount. Then you will also have to depreciate the asset on the new cost basis, and if at all reversal is required, you can also do the reversal. If the asset, I mean coming to the other side, if the asset is held for sale or disposal, that means you are not using the asset. In that case, you simply take the lower of the cost or fair value, that is cost less the cost to sell, or we also call it as a net realizable value, but you will never charge any depreciation. Since you are not also calculating the impairment, there is no question of reversal of impairment. Okay, so this is the whole discussion of impairment topic. I'm going to the last objective, that is depletion. I'm sure you remember the word depletion from your accounting 2 classes. It is the same idea like depreciation. However, depletion is the allocation of cost for a special type of asset. There's the asset which is basically mineral resources. I mean asset for mineral resources. That is maybe oil and gas and assets in those categories, right? So natural resources, they can be of two types. Now, when we can still classify natural resources into two types. The first one is called the biological asset, which means asset which is living, It can be forest or timberlands. It could even be the ocean with the fish and so on, right? Normally we use a fair value approach. It was discussed in chapter 9, which we are not doing in our syllabus here. And the second one is the mineral resource like oil, gas, minerals, mining and so on. So in this case, what we do is we talk about minerals as assets which is maybe inside the earth and it is yet to be removed, right? So each time you remove it, it goes out of existence and it is non-renewable. This is what I meant to say, right? So, and replacement can happen only by the act of God. So this is the definition of mineral resources. In this chapter, I think we'll be talking about mineral resources. So let's go on ahead. So again, the same idea. Whenever you want to charge the depletion, you first need to identify or calculate the depletion base. Depletion base, you will take the pre-exploratory cost. Now, pre-exploratory cost is the cost even before you start extracting the minerals. Imagine Aramco. It spends a lot of money for research to identify the site where they can start the exploration, maybe the research and maybe things that they spend on transportation and whatever cost related to that acquiring of the asset. right? Second is the exploratory and the evaluation cost. So once you start the exploration, all the cost involved will be the cost of your mineral asset, or we can call it the cost of the natural resources, and also the development cost. So all cost that is involved can be considered as the depletion base to calculate the depletion amount. So write-off of resource cost, in other words, allocating of the depletion cost to each of the year. Normally companies compute depletion using the unit of activity method. It's same as unit of activity. So depletion is the function of the number of units that is extracted during the period. So you say cost minus the residual value divided by the estimated units available. This will give you the depletion cost per unit, and multiply it with the actual extracted unit, and that will give you the depletion cost for the period. Okay, so here in this case, let's use a small example. Let's say the company, MacLeod company, has acquired the right to use 1,000 acres of land in South Africa to mine for silver. The lease cost was 50,000 and the related exploration cost of the property was 100,000. Intangible development cost incurred in the opening of the mines are 850,000, and it's estimated that the mine will provide approximately 100 ounces of gold. Okay, so they went to mine for silver and they got gold. Okay, let's have a look at that. So you use the formula to calculate the value. So you got your cost minus the residual value. Here I think they have not mentioned any residual value, so you just add up all those costs. um, 50,000, 100,000 and 850,000 is giving you 1 million euros divided by 100,000 ounce of gold. That means for every ounce of gold that was extracted, the depletion cost would be 10 euros. Fine. So if MacLeod extracts 25,000 ounces in the first year, then the depletion charge for that year is going to be 250. That is 25,000 ounces into 10 euros per ounce. And the entry that you will pass is, normally in a mine company, they do not call their asset as a property, plant, or something like that. Instead, they calculate the number of what to say ounces available and consider it as the value of inventory. So each time they take out, it goes into the value of their inventory. So they will debit inventory with the amount of depletion, and accumulated depletion would be credited. And in their balance sheet, they are going to show maybe gold at a cost of $1 million and less accumulated depletion 250. So the book value would be 750, and depletion cost is related to the inventory, and it goes into the cost of goods sold when you prepare your income statement. Estimating recoverable reserves. Estimating recoverable reserves. What does that mean? So it's same like you're changing the same as the accounting for changes in the estimates, like we have already discussed in the previous chapter. So you can revise the depletion rate. It can only be in a prospective basis, not in the retrospective basis. Remember what we discussed in the depreciation? We said that you cannot go back and correct the mistakes that you did in the past. You have to just go forward, look forward, and make the changes for the current period and for the future. So you need to just divide the remaining cost by the new estimate of the recoverable reserves. Let's take I think there is no example here, but I'll take one more concept. This concept is called liquidating dividends. Now, this mining companies are special cases. Now that if you are shareholders of Aramco, it's a good time, to learn how this company do their businesses and how they calculate their values and so on. So here is a concept called liquidating dividends. Now, what is the general meaning of liquidating dividends? It actually means that the company is paying dividends to its shareholders, which is more than the amount in their accumulated net income. That is, after adding their retained earnings and all the monies that is available, the company is paying more than what is available for the shareholders. This is actually done when a company is liquidating. That is when the company is trying to close down. Okay, so let's illustrate that. Let's say Callahan Mining had a retained earnings, a balance of 1,650,000, accumulated depletion on mineral property of 2,100,000 pounds, and a share premium of 5,435,493 pounds. Callan's board declared a dividend of £3 a share for the 1 million share that was outstanding. It records 3 million pounds cash dividend as follows. So when it declares, when it has a retained earnings, that means this $3 million dividend that the company is giving as cash, only 1,650,000 can come from the retained earnings. So debit retained earning 1,650,000. The remaining money is taken out from the share premium if there is a paid in capital in excess of par value. If such an amount is there with a credit balance, you will debit the remaining amount, because that is where the money is coming from to pay this dividend of 3 million to the shareholders. So debit share premium amount first of all, and later on maybe even share capital if they're actually paying the liquidating dividend out of the capital funds. Okay, and credit cash. So this is the concept of liquidating dividend. Now this is done by mining companies, especially when the company is almost reaching the end of its life, meaning that the extraction company has finished extracting everything that was in their control, and now they have to close down. Okay, so that's the idea there. Okay, where do you show the depletion in the financial statement? So basically, we talk about exploration and evaluation expenditure. There are some accounting policies for that, and it's coming in the short form E&E expenditure. So whenever the company is in a mining field, they have to follow the accounting policies for the E&E expenditure, which is including when do you recognize this expenses. So the amount of assets, liability, income, and expenses, and also the operating cash flow which arise from the exploration of the mineral resource must be evaluated independently. Okay, so that's the idea. So I'm stopping the chapter discussion here. Basically, the remaining part of the chapter I have just deleted because I think it is enough to discuss this. The remaining part was actually valuation and presentations and so on. I mean, revaluation and presentation. So I'm not doing that. Okay, so here I thought I'll also give you the exercises that are included in this chapter, and I'm not giving you the solutions to this exercise because I want you to work it out on your own. BE 11.1, 2, 3, 4, and E 11.1, E 11.4, and E 11.11. So by the end of next Tuesday, if you can all prepare the answers to these questions and submit via the Blackboard on a DOC file. Okay, so with that I end chapter 11. I hope you have understood this. Please let me know if there was any questions or concerns, and please feel free to interact with us on the discussion board. Have a lovely time, keep safe, okay, and take care of yourself and your loved ones. Bye.